Welcome to the CPG Guys podcast. Your hosts, Shri Rajagopalan and Peter V.S. Bond, explore how brands and retailers engage consumers in an increasingly digitally driven world. And now, here are the CPG Guys. Hello and welcome to the CPG Guys podcast. I'm your co-host, PVSB. I also moonlight as head of Industry and Client Engagement at Flywheel, the e-commerce acceleration division of Omnicom. My co-host is, of course, the patriarch of the Raj family media empire. He's also Chief Revenue Officer at Think Blue Consulting. He's the man known as Shri. Today's episode was recorded in Chicago between Shri and our dear friend Nik Modi, who is the co-head of Global Consumer and Retail Research at RBC Capital Markets. Nik penned an article that just came out where his recommendation to consumer goods companies and their boards is it's time for them to cut their earnings per share significantly. It's a very challenging time, and Nik details exactly why he's arguing they make this change. Shri has a great conversation. We hope you enjoy it. And if you do like what you're hearing, please make sure on Apple or Spotify to give us a star rating and to leave us a review. That will improve the likelihood that our podcast can be found by other industry contemporaries. With no further ado, here's Shri and Nik.
Of course, it's my privilege to welcome back to the show none other than Mr. Nik Modi himself, Managing Director and Analyst for RBC Capital, a friend of the CPG Guys who's been on twice before, another 2 times, and he'll earn the famous CPG Guys Letterman jacket. But it's a pity he can't take a swag from somebody. But this is, of course, it's free media. We give it to anybody who appears 5 times on the show. Nik, of course, has just recently published a report. I would actually call it a scathing report. That actually, this is the title. So I'll let you all kind of listen to this episode and judge for yourself. The title of this report says, CEOs, is it time to cut your quarterly earnings estimates and EPS estimates? And that title intrigued me significantly, having a 30-year career in CPG, kind of being married to deliver the quarterly EPS estimate. And that's what entire playbooks were written out of. So Nik, it's a pleasure that you're making time for me late on an evening on a weekday over here. Welcome back to the CPG Guys, man. How you doing?
I'm excellent. Thank you for having me back, Shri. Appreciate it.
Awesome. So let's jump straight into it, Nik. You don't need any introduction to the industry. We've already had you on the CPG Guys. Of course, in the digital liner notes of this episode, there'll be links to the previous episodes that listeners can listen to on the go and access. So I'm going to first start with how we met earlier this year and an earlier episode we had with you, which was more of a CAGNY recap.
Yep.
You and I have chatted briefly in the past few weeks, and we've kind of questioned why CAGNY even exists. In your mind, somebody reporting out on CPG performance routinely and often, why does CAGNY exist? Should it exist in the future?
Yeah, I think, look, if you think about the whole genesis of CAGNY, right, it was at a time before, company CEOs would webcast earnings results or management presentations. And it was a time for people to gather and rub elbows with managements of a lot of these wonderful companies. And time has evolved, and now it's become more of a just gathering of people. I mean, I love to go to see my clients, to see the companies, to see them in person. It's probably the only time of the year you get everyone together, right? So it's become more of a social dynamic. I think from a content perspective, there's still value on the companies getting up there and presenting, but I just think that things have to evolve just a little bit. I think what investors really want to hear at CAGNY is how companies are addressing the market. How are they addressing their challenges, right? I mean, it's wonderful seeing the advertising and hearing about the next new product innovation, but what are they really doing to address retailer media? What are they really doing to prepare for a much more volatile geopolitical landscape, right? I mean, I think that's really what investors want. They want to get that clarity. And so, I just hope going forward, as the companies prepare for CAGNY, they take a very investor or consumer-centric approach, right? They're there to address the investor population, and I think they should do it in a way that addresses those investors' questions.
One of the things I've heard you say publicly, and this report kind of hits upon it, is if you look at historical performance of the consumer staples stocks, ones that you track, and then the industry as a whole, right? So how many stocks is it that you track routinely?
Well, I cover officially 32 companies, but I track close to 500 across the entire supply chain.
So if you look at a 30-year performance, the numbers are actually not that great. Can you give some highlights on what they sound like?
Yeah, I mean, if you go back, the consumer staples sector relative to the broader market, so that's the S&P 500, over the last decade has underperformed by close to 100 percentage points or 100%.
That's a big number, man, like 100 percentage points versus other sectors. Like, are you kidding me, man?
Yeah, it's not been very good. And the thing, and the reason why I wrote the report I wrote is I've been covering this industry for 25 years. I love this industry. I think it's a phenomenal industry, great margins, great returns, amazing brands. But the sector has just become a place where people want to hide out when things are scary, and that's it. And when things get better, no one wants to own these stocks again.
But Nick, even in that environment, how can 100% decline compared to other sectors be stability? How's that stability?
Well, that's kind of my point, right? And, if you go back to the early 2000s when I first started covering this industry, the only times the consumer staple sector has really outperformed the broader market is during times of significant distress, right? The dot-com bubble bust, the great financial crisis, right? And moments like that. And so I just think that we need to do better. We need to get back to basics, back to fundamentals, understand that consistency is really what drives the value creation of these companies and not be so near-term focused, right? Because I think all the near-termism has costed many of these companies from really capitalizing on long-term trends.
So your report kind of highlights and has a conversation, kind of puts the data out there about this near-termism, right? But the title of the report kind of says, it's time to bring EPS down. Tell us more. What did you mean with that title? Is Wall Street generally trying to communicate? Are you trying to communicate to CEOs or consumer staples? I'm going to give you a one-time buy. We're going to give you a one-time buy as long as you're consistent, even if you have to adjust.
Right.
But as long as you're consistent.
Yeah, that's really the message. And again, I'm not trying to be, hyperbolic or alarmist. It's just I've been covering this industry for 25 years, and I see the deficiency in certain capabilities that I think are going to be really, really important as we move into the future. And cutting marketing and cutting analytics in this moment in time is not a very good idea, in my opinion, right? So the way I really think about it, and really, what I was saying in this report is like, listen, you could keep on revising your earnings downwards 1%, 2% here and there, but that's been going on for the past 6 quarters for many of these companies. Or you could just do it one time, create a target that is very believable, and create enough flex in your P&L that you can invest in these capabilities. And let's just face the facts. The world is much more volatile. So we're going to have to absorb a lot of risk, right? How can you deliver a number and still absorb that risk while still investing in your business? That requires numbers to come down, right? And that was really the whole intent. I'm not saying that these companies can't grow in line with their historical algorithms. I just think we need to take a step back. We need to realize that we're deficient in certain areas. We need to rebuild investor confidence. And I think that takes a good 1 to 2 years to do.
And so, Nick, one of those historical precedences that existed, even when you came on the show, let's say early February versus where we are mid to late April, in the 8-10 weeks that have transpired, there's a new word, kind of the word of the day, the word of the month, the word of the last 12 weeks, and it's called tariffs. Tell us about what you guys are seeing as analysts as an impact to the consumer staples industry. Is tariffs real? Is it short term? Should companies panic the way that they are? What's the outlook here?
Yeah, so I think there's a lot to this, right? Number one, obviously there's going to be some income statement headwinds that come with the tariffs. So Kimberly-Clark just reported today they took down their earnings, rightfully so, I thought, and they called out $300 million of incremental tariffs. I think that's smart because in a normal scenario, what many of these companies would be tempted to do is try to figure out a way to offset it, so not to have to lower their numbers. But I think what a company is starting to realize is, hey, we can't cut back on critical spend right now. We got to keep going because it has an impact long term. I mean, think about what happened during the 3G era, right? Amazing profit growth, but then top line started to struggle and these stocks didn't respond to the earnings growth because no one thought it was sustainable. How can you sustain these types of margin gains when your volumes are negative and you're losing market share? And so I think a lot of the companies are starting to come around to this thought process, right? And so obviously tariffs will create some headwinds. It'll create consumer anxiety, right? And that's partly what we're seeing in the March quarter is we're seeing weakness. And I think that's part of people worrying about prices going higher at a time where prices are already too high, right? And we probably have to see some retrenchment there. The third thing, and I think this is really where analytics become really important. Not every company has the same supply chain. So some companies are advantaged versus others. Some companies might have much more U.S. production. Well, that's part of the chessboard, right? And you got to take advantage of it. And if you're one of the companies that's not advantaged, you're disadvantaged, you got to figure out how to mitigate risk, right? So I just think there's going to be a lot of analytics that needs to be done to really understand how best to navigate the situation.
One such question I have for you on analytics is partially science, but it's also partially art. Traditionally, the leaders that have risen to the top, they're very good on the art side, which is the art of taking the output that's given to them by other teams, massaging it in storytelling. And they've been P&L managers. So can we talk about talent for a quick few here?
Yeah,
so
absolutely.
If you go back last 20, 30 years in history, my humble belief here, the leaders at most CPGs are either financial leaders, CFOs, or the old school used to be marketing leaders. What do you believe is the right talent set that should be leading these companies? And I don't just mean CEO, I mean generally leadership from a, let's say, go-to-market perspective or operational leadership. What talent base would excite you?
Yeah, it's actually an interesting question. I'm less worried about the talent. I wasn't very smart coming into my job, but I've been doing it 25 years.
Who are you kidding, Nick?
But the point being, Sri, is experience matters. Okay, so
tell us more about experience. What type of experience matters?
You need to have some kind of intuition, right? Like we can all process data. I look at data all the time. I mean, that's my job. But sometimes I say, well, this is not telling the complete picture because I know based on my 25 years of looking at this
industry. If you look at the 30-year historical performance, I mean, I looked at your report and I read it cover to cover, word by word. If you look at the 30-year performance and you benchmarked it to other sectors, like you said, a minus 100 basis points. I'm sorry, not a minus 100 basis, 100%.
Yeah.
That's pretty pathetic. And what kind of intuition of a group of people delivers minus 100% results compared to other sectors? Now, we can say compared to other sectors, but that's not an excuse.
Well, let's tease out some of that.
Yep.
Okay.
Yep.
Because not every company is built the same. I'm giving you an aggregate number.
Absolutely.
Let's take Church & Dwight as an example. Okay. Their brand managers have been doing that job for a very long time, and they're very good at their job, and that's why they out execute companies that are much larger and maybe have brands that are much bigger in terms of market share. Because these brand managers are spending so much time, they are experts in their category. It's like an analyst for a sector, right? In my job, if I kept on switching industries, I would never be able to have the intuition to provide forward-looking perspective that is accurate, right? And so I think the whole notion of building talent for the next role has gotten in the way of building expertise, domain expertise. And in this world where things are changing so quickly, I think domain expertise is required. I think what's happening with today's leaders is they're lacking intuition because they haven't been in their role long enough. Does that make sense?
Completely understand, yeah.
So I think it's less about talent.
And it's because they're usually seen as a emerging leader and they're fast-tracked to 15 rotations.
Correct.
And they just haven't been long enough in an operational role, a sales role perhaps, or a given brand marketing. Is that
exactly
what you're hinting at?
That's exactly what. Now, think about the world that we're walking into with AI. You need human intuition to really accentuate and magnify the capabilities of AI. And so I just think the industry really needs to rethink how they rotate their best people around.
Let's talk AI for a bit, right? AI is a phenomenon that I don't think our industry totally grasps yet, the intensity. And that proof in the pudding was CAGNY, where most leaders that presented on stage kind of said, hey, my IT leader or CTO has a mandate, which means they're hinting at chatbots and customer service on a web page. What's your opinion? What change is AI going to bring about in the industry?
Yeah, I think the way the industry is thinking about it now, it's like in very siloed ways, right? Hey, here's innovation, here's marketing, here's sales, here's this function. And then AI is going to make each of those individual silos much more efficient, okay? But what I think is going to happen, or what should happen, is AI needs to be an enterprise level initiative that helps bring all of those different capabilities and functions together. So the organization almost has to be redesigned to take advantage and leverage AI. And let me give you a few examples, right? We should get to a point where we have box level assortment. You know, this retailer and that retailer that might be 2 miles apart should not look the same, should not have the same planogram because they have different shoppers. That's where we should be. We should be at a point, the capability already exists, where companies should be able to do one-on-one personalized marketing at scale that's not very costly. The capability already exists today. Why don't we see it, right? We should be at a point.
It barely exists.
It barely exists. You know, P&G, I think, is on the cutting edge in terms of using AI in innovation, right? And coming up with product concepts and molecules much faster, right? So these are the things. But the thing that I worry most about with the industry is how shoppers will shop in the future leveraging AI. It won't be you or me making the choices. It'll be an actual AI agent.
So publicly, again, I've heard you talk about, you gave a fabulous example of your own agentic AI shopping. Can you take us through that and explain why you see that as agentic AI? Because to me, when I heard you give the example of how you were shopping for Easter, it's actually pretty scary because the way a CPG brand represents itself, it wouldn't make the cut.
Correct, right? So it's almost like a prompt like you would have in any AI platform. I'm having an Easter party. I'm having 20 people, 10 are children between the ages of 5 and 10. We're going to have an Easter egg hunt. We're going to have a traditional Easter style dinner. And I'd like to make popular cocktails for Easter. I have 3 vegetarians and 2 people with celiac. Boom.
But nowhere in that little dialogue over there did you name a brand.
I didn't name a brand or a category. And that's the question. So think about how things have evolved, right? We went from shopping in the store, going down the aisle.
You didn't even say beverages.
I didn't say anything, right? But that's the point. And wait till voice ordering. And this is where the older generations are going to really adapt voice ordering because it's going to be so easy and seamless, right? It's not going to be complicated for them to get on a device and do all this kind of stuff. So the core CPG shopper is still the older consumer, right? So the industry's really got to wake up. And, you know, you went from a situation where you were going down the aisle, seeing all the options. If you're packaging pop, maybe you had a chance. Then you went to the online where maybe you pay some retailer media dollars and you're up front and center at the top of page 1. Now you're going into an environment where the agent is making the decision based on what? Product efficacy, customer reviews, ingredients, right? So it just really, really has complicated the path to purchase. And I'm not sure that most companies I follow are prepared for this moment.
So let's talk about that preparedness for a second here. I'm not talking about talent. Let's leave that to the side for a second. Because to be prepared, you have to have the talent that understands it. But let's just leave that to the side for a second. I'm talking about all the underlying basic pieces that determine the outcomes to the algorithm. You just mentioned ratings and reviews, perhaps the digital images, how search is planned for brand keywords versus category versus other terms. Efficacy was a good one you just said. You used the word vegetarian, which I'm not so sure most brands that are out there in the marketplace will ever find anything if you put that search term in your agentic AI. Do you think CPG, again, leave talent to the side for a second, this is purely algorithm influence? Is it ready?
No, I don't think it is, to your point. And I'm not even sure, if companies have really figured out exactly how they would actually get their product in the basket, or actually what governs it, right? Like what does govern it? I don't even know, right? Is it customer reviews? When I did my Easter example, I said, find me the products with the best online reviews, right? And so if you think about it, now all of a sudden, it's not the might of the marketing only that matters. It is the product efficacy, because we're in a social selling world now where it's not I'm taking cues from these big marketers. I'm taking cues from you or other people, or even people I don't even know, but I follow on Instagram or another social media platform. Product efficacy is how recommendation happens. And so every company has to really think about blind wins, product superiority, things that we've heard from companies like Procter and Clorox. This is, I think, the way forward.
So, Nick, I want to counter that by saying, if you looked at social commerce, I learned today that TikTok is now the 9th largest beauty retailer in the US, which is insane if you thought about it. TikTok social commerce is the 9th largest beauty retailer. That is crazy. Yeah. That's larger than most grocers. That said, for large CPG brands, entire business models are built on preserving brand equity by risk aversion. The whole notion of influencer and social commerce, you have to get away from being risk averse to being bold, which CPG companies are not built to do. They have entire corporate comms teams. I've been subject to much of that. They have PR teams, publicity teams that manage all that stuff. What's your advice for them? Because they don't have the structure to respond. And that's the reason they also don't want to invest in one-on-one marketing.
Right. So look, there are a few solutions here, okay? Number one is we need to invest, okay? And that's why I made the comment about numbers have to come down. And every company knows I'm right. That, they might resist, they might not think they have the permission, but they do. I mean, look what happened with Constellation when they cut their numbers. Stock went up. Look what Kimberly-Clark did. They cut their number for earnings from high single digits to flat, and the stock is only down 1.5%. Okay? So trust me, investors want visibility in this sector. That's what they want. If they want growth, they'll go to technology, they'll go to biotech, they'll figure it out in another industry, but they want consistency and visibility in this industry. And you can't do that when you think numbers are still coming down. So that's point number one.
Isn't that the issue that you're pointing to, that in the 3 years of COVID, 2020 to 2023, the industry largely forgot our role is stability. Right. And with the pricing actions we took, we got 50% bump in stock prices because we suddenly became 10 and 15% growth giants year over year like tech. And hence we had the stock price. But that fall from almighty has been pretty painful because most stocks have settled to pre-COVID historicals. Isn't that the issue, like the loss of way here?
Well, it's part of the issue. But Sri, this issue has been around even before COVID happened.
Right. When you say it's minus 100%, it's long before COVID.
Right. Yeah. Exactly. Right. So look, there's a lot of solutions, right? So first, you got to create the P&L flex to invest in capabilities. Second, you can't get...
Nick, let me counter that as well. So without the P&L flex, you can't really invest in capabilities.
Right.
Yet, leadership prioritizes delivering the dividend for the quarter and EPS.
Right.
So how do you break out of this? Your report certainly tells them break out of it.
Right.
How do you break out of it? What do you want to see? What actions do you want to see?
Well, I want to see actions like what we saw from Kimberly-Clark. I want to see numbers come down because investments are still going to happen. That's number one.
So I want to decompose that a little bit more, right? So are you saying, Nick, if a CEO were to step up, a company was to step up, leave the CEO title alone, and say, look, I need to set aside and I need to develop capabilities, as you just mentioned. AI is a big part of it. Without solving AI, I think you and I both see eye to eye. Your brand is doomed 3 years out, 5 years out. You may be non-existent because someone else will eat you for lunch.
Right.
In that sort of scenario, if a company came and said to you, look, I'm going to take my earnings estimate down. It's not what you thought it was. My dividend is going to settle out at a certain number. There'll be no growth in dividend for 2 years. Would you then say, give me the plan? I want to know where you're investing.
Yes.
And once you know, do they get a buy on a reduction, significant reduction in stock? While you can't promise anything over here,
right?
Is that the thinking?
I think when you look at how investors would react or have historically reacted to situations like this, they want the visibility. So
Do you get the visibility today?
Well, you don't have it now, but if I felt like flat earnings growth is achievable even in this environment, then that makes me feel a lot better than, they're trying to deliver 7-8% earnings growth, right? And so historically, look, we've seen this happen time and time again. Investors do respond to this in this industry because they want the visibility. But the other thing that I would encourage the companies to think about is if you do that, where is the money going to go? I want to know what capabilities you're building.
That's my point, Nick. You're going to want to actually know, I'm putting into solving agentic AI. I'm putting it into innovation. Here's how I'm informing innovation. I'm taking bold new steps that are going to define the future of not only how I'll source innovation, but how I'll build it to how long will that innovation last, trends, predictability. You want to see all of the above.
Correct.
Assortment planning.
Yes, and that's all very achievable.
And can I flip the question to the other side of the fence? So we talked about talent on the CPG side. I listen to a lot of quarterly earnings calls across the board, multi-sector, not just food and bev. Sometimes I feel analysts are not asking these questions. And one such question is, in the industry you and I touch, food and bev staples, retail media isn't right in the middle of it, and the numbers are not small.
Right.
For the companies you and I track and observe, $100 million plus.
Yep.
That's a lot of money.
It's a lot of money. And
200 million, 250 million, 300 million, it peaks out there. Do you think Wall Street is asking the right questions about this? Because I rarely see any one of those quarterly estimate calls ever ask a question or dig in like you are today.
Listen, I think obviously on public forums, sometimes companies are hesitant to bring up sensitive topics. And this is a sensitive topic, right? Because the reality is,
Do you consider CAGNY a public forum?
Yeah, I do.
Because it is kind of closed door.
Well, it's closed door, but everything is webcasted, right?
Fair enough.
Yeah. So to me, it's a public forum. But when I think about this topic on retailer media, or even addressing private label, there's sensitivities with the retailer. So I understand why they may not talk about it. I agree with you. I don't think investors truly understand what is going on with retailer media and how much of a challenge it is for the suppliers to think about, like, where do I spend the money? Part of that is because they don't have the capability to understand where they get the best return.
I think that's the root cause.
So
what would you want to hear on retail media from the industry?
What I would want to hear is them telling me that they have some kind of quantification that spending more on retailer X will give them a better return than retailer Y, and that they have to make the right decisions and fish where the fish are, right? Yeah. And that at the end of the day is what I think. But I don't think they're there yet. Right? I think they're just saying, like, oh my God, there are 200 retailer media platforms. Like, what do I do? Because let's not kid ourselves. This is not a one-to-one marketing to retailer media exchange. We all know it's incremental.
Absolutely.
Right? And that's part of why they don't want to talk about it on these public calls. Right? But Sri, just going back to your other question, or original question about what can they do? One of the things that, and look, again, 25 years, so maybe I'm allowed to be more creative than some of the executives. But,
you've earned that.
Yeah, I hope I have. But maybe we're just chasing the wrong metrics. Maybe quarterly earnings is not the right metric.
That's the problem.
Maybe it's product superiority is the right metric.
And then from a Wall Street perspective, isn't it a new scorecard that you all have to develop then? Because today's scorecard is, give me 4 cents. I use 4 cents here pretty fictitiously, whatever it is, like a 1% increase in the dividend, which has to relate to X adjustment in EPS. That's the template of the scorecard. And that's why leadership is P&L oriented versus growth oriented.
Well, fine. If they want to chase the numbers and they think that's what they want us to do, that's
not what I'm saying they want to do. That's the scorecard you all have given them.
Right. Well, that's actually
like a template and said, fill it.
That's where the disconnect is.
That's what I want to hear from you.
Yeah, that's where the disconnect. If you think about, like, let's take the 3G era.
Yep.
Amazing profit growth.
Yep.
Right? But the stocks started to underperform despite big earnings beats because the investor was like, wait a second, this isn't sustainable. How can your volumes go down, your share go down, and your margins keep on going up? Like, this doesn't make any sense.
And then there was exactly what's going on now.
Right. And there was a correction. So whether investors can articulate it or not, they actually care about the long term. And I showed through quantifiable means, 80% of a given consumer staples company's market cap, publicly traded market cap, is in year 10 and beyond of the forecasts. So that means years 1 through 10 is 20 to 30% of the market cap. And then that makes it 3 months of profit even smaller. So what are we really doing? Right? Let's pull the frogs out of the boiling water and let's recognize that whatever they've been doing on the hamster on a wheel hasn't really been working as per the long-term returns. Now, again, not every company is built the same.
Can't argue data.
Right. This is an aggregated comment. I would say it's probably relevant for 70% of the industry. There's 30% that actually gets it right. Okay. And you can see that in the stock prices, but it's like this. When I started really seeing benefits to my health and my weight was when I stopped worrying about my weight and I worried about the actions. I worried about drinking enough water, making sure I was working out, cutting down on the bad foods, and then only then did it work. But it took me 49 years to figure that out, right? So that's my point: is that are we focused on the wrong metrics? My metrics now are: am I doing the right behaviors, right? And I don't think it's any different for these companies.
So I got a couple more questions for you here. One is on behaviors. So a lot of industry turmoil and the current administration and expected legislation change, especially in the food and beverage sector. Are y'all looking at that closely? What's the outlook?
Yeah, I mean, obviously everyone's paying close attention, but it's so hard to understand exactly how it's going to play out. Now, a lot of the stuff that they want to do, whether it be removal of this or take SNAP out of that, there's a legislative process, right? And I remember when
But with the current administration, do you really think we're going to go through some lengthy legislative process?
I do, because I think at the end of the day, everything's going to go through the court system. And so we're really going to be testing the courts quite a bit over the next year. I mean, I remember when I covered tobacco, the government wanted to ban menthol in 2009, and it still hasn't happened. So it's 2025. Now, do I think that certain ingredients need to come out of the food system? Of course. And do I think it's going to have a big impact on the industry? No, I don't, because it's going to be ubiquitous. If one company decides that they're going to get rid of it and another company doesn't, and there's a very distinct difference in how these products look on shelf or in the actual bowl or plate, that's where the problem arises. But if everyone is doing it, then it doesn't really matter. Right. And so I'm not too concerned with some of this stuff.
So let me then jump into the next 3 months. What are you expecting to see from the industry? What's your outlook as you look through the numbers, the data? Obviously the stock market in the last, let's say, 3 odd months, consumer staples has significantly underperformed, but it's still benchmarking to the overall stock market. I'm only talking last 3 months, not the 30-year number that you gave.
Yep.
Do you see something changing in the next 3 months, or is there still a lot of trepidation in the mix here?
Sure, I feel like we're on the precipice of companies finally acknowledging things that we've been talking about for the past 18 months. Right? We're seeing it. Numbers are coming down. People are acknowledging the challenges. It's unfortunate that it took this long, but we're here. And I think that we're starting to see some of the right choices being made. And that gives me hope. Right? Because I don't think that we have problems that are unfixable. I just think it takes courage. I call it courage arbitrage.
Yep.
Who has the courage that others don't to actually make some of those tough choices to put us in a better position where that 80% in years 11 through infinity on the forecasts are okay, right?
That is crazy, by the way.
We want the 11 to infinity to exist. We don't want it to disappear.
Yep.
And if companies don't make the right choices, that's something that is a probability.
One area we didn't get into, which you and I have spoken outside of this conversation, is innovation. Innovation in the industry largely seems to be indicated as strategic M&A is the way go forward for the next few years. Are companies are they cash rich? Are they sitting on a bunch of cash? Do they have the cash flow? Do you see a lot of consolidation happening? And is this the way to innovate?
I don't think it's the way to innovate. I do believe once the markets settle, we will see activity.
That's more a consolidation, or is it something else?
That's more consolidation, bolt-ons, a combination of the two. Capability-wise also, right? I think there's a lot of capabilities that need to be acquired because maybe building it might be too expensive. But when I think about innovation, I think the industry has to really innovate how they think about innovation. Maybe it's not about launching a new product based on a trend that's going on. Maybe it's just simply merchandising or partnering with other companies to provide a solution to the consumer that they're looking for. Maybe it's about product efficacy, right? Maybe it's about the product quality, and that's where the investment needs to be. So I think there's a lot of other ways to think about innovation that the industry is not doing. I think they're making it maybe a little too hard on themselves on trying to chase some of these trends, or saying, I don't want to chase these trends because, it's a fad, but you don't need to actually create a new product. You can execute it at retail in a way which allows you to capitalize on the trend.
I got one last one for you here, Nick, and that is advice to the industry. If I gave you the microphone here for the next couple minutes and said, you're now in a room full of CEOs in the consumer staples sector, and they've literally said, Nick, they're not asking you what would make you happy, Nick. They're saying, you look at all of us, you track all of us. If there are one or two pieces of advice that you think we should act upon immediately, and remember, my question is immediately, versus long-term, versus investing in the next 6 months. What would warrant an immediacy?
So I think there are a couple things. Number one, do not cut back on insights and marketing.
So let's talk about that a little bit, right?
Yeah.
Historically, when the P&L needs a trim, there are three areas that leadership goes to. First is T&E, and the industry now is full of news that we can't travel, we can't come out to this, we can't come out to that, can't go to conferences, yada, yada, yada.
Right.
The second is data and insights. It's seen somehow as a luxury and a discretionary purchase, which I don't understand. Maybe T&E is. You can be choiceful, but data and insights is how you run your business. And the third one is media, retail media being one of them.
Right.
Talk to us about all three. T&E, agree, disagree?
I agree. T&E, I think there's tons of ways to, and in the post-COVID world, there's a lot of ways to access information without having to actually get on a plane. Trust me, I've leveraged that quite a bit because, I travel a lot.
Yeah, I mean, we literally talked a little while ago about, do we even need an in-person CAGNY versus we have so many webcasts and webinars and things of that nature, right? So I get that part, but insights and data, that one mind-boggling to me. You'd probably need more data to generate more insights now than ever.
Absolutely. And I think that we also have to re-innovate and think about how we use data, because everyone has these templates. They look at the data. They got a lot of data coming in. They got these data lakes.
Metrics from 30 years ago.
But it's just a lot of data. And I don't know if it's being leveraged and processed the right way. So the way I've kind of thought about my job, right, because I look at data all the time, is that instead of getting inundated with the data, I have problems that I'm trying to solve, and then I find the data to help me solve them. And the data will not be just from one source, it'll be from multiple sources. But that's kind of how I go about doing my job, and I don't think my job's any different than how a consumer brand would try to think about their own brands and the challenges that they have.
Yeah, no doubt about that one. And the third one, Nick, I'd ask you, is the media. There's a lot of cutbacks in media. Traditionally, media has been a hole filler on the P&L to close the quarter to deliver an EPS estimate.
Yeah.
And there's a lot of that floating around. Media budgets have been pulled back. What's your take there?
I think what's important for the companies to understand is that, and you could just look at historical performance. Typically, when a company beats earnings and they're celebrating because they beat the quarter, and they cut back, they do it by cutting back on marketing, the stock typically goes down. And that's because investors can see through it. They understand that, wait, this is not sustainable, right? So it's just, you're not doing yourselves any favor. That's why I call it hamster on a wheel. Like, they keep on doing this practice because it's a legacy practice, but it actually doesn't work, right? And you can see it in the data. I mean, I have plenty of examples I can share with people on this very topic. And by the way, anyone listening to this, I'm happy to have the debate. If you really feel strongly that I am wrong, call me.
Which aspect are we discussing here?
Anything.
On the media,
on the cutback, on my entire philosophy.
The EPS, the conversation
Absolutely.
about quarterly versus long-term.
Changing
EPS.
the metrics. Let's have the chat.
Well,
that's what the industry needs.
CPG guys are happy to facilitate that dialogue. And perhaps in the future, we can have a brand and you as an analyst kind of come have a chat about this very topic. And I'd love to also enable you to be able to see from a brand lens, why they hold back on many of the things that you said.
Oh, I know why they hold back.
It's to deliver the dividend.
That's right.
I'm telling you, man, that's...
No, I know that.
30 years, I'm finding it hard to let go of that philosophy that at the end of the day, what mattered And when you're junior in your career, you don't understand this.
Right.
The more senior you get, you realize that your sole mission and purpose is to deliver the dividend if you're public.
And listen, I'm not gonna say that my part of the industry isn't part of the problem. I think every part of the supply chain and the stakeholder base is part of the problem, right? Asking these very near-term questions, and I get it. And that's part of the problem. And that's what has trained many of these executives to think that that's what matters. But I'm just saying, pull yourself out of the boiling water, go back in and realize how hot it is, because it actually isn't as important as you think in terms of 3 months of results.
So here's the deal we'll make, Nick, if you're ready for it.
Yep.
The CPG guys will keep coaching the industry that you need to move away from quarterly estimates to maybe this one-time adjustment, but be consistent with that adjustment and then deliver what's realistic, especially given the last few years of inflationary pricing. Then reinvest if you have to, but share the playbook of where the reinvestments are going. So we'll do our part. Now, we'll ask that you do your part on the scorecard with Wall Street too, because it requires both sides to meet in the middle. And both sides need to do it, not just for their personal gain, but for the consumer.
Yeah.
Because you know who the biggest loser is in all of this when these adjustments are made? The consumer, because they're not getting world-class innovation. They're not getting the right prices.
That's
They're not
correct.
getting the right products, the right packaging, none of that stuff.
Yeah. We just have to do a 20-year audit and realize how many emerging brands have come to the table because the big brands have not done the service to the consumer, right? And so we just got to get back to being consumer-centric. That is the advice.
You know, so I said that was the last question, but sorry, I got one more since you brought it up. And that is, who's winning these days?
Well,
emerging brands?
Yeah. No, look, I think the companies that are focusing on product superiority are winning, right? Sometimes that's emerging
value.
Yeah, a good narrative story, right? And so marketing still matters, right? That emotional connection and making it relevant in certain occasions and creating disruptive innovation that sometimes might be margin dilutive, but hey, that's what the consumer wants, and you can build scale over time and build your margins and profits. But we have to stop being scared of negative mix due to innovation. That is something that I think the industry has to get away from. And here's the last point I would make, is that there is so much robust information in the periphery of every organization, merchandisers, route drivers, salespeople, whoever. And I think every company needs to figure out a way to manifest, to collect, to aggregate, to figure out how they can leverage that insight that is within your four walls and help inform the center in terms of being consumer-centric. Because I promise you, when I listen to my son talk with his friends about what's going on TikTok and how they engage with products that these companies sell, it's very different than what I'm seeing in investor presentations and in my interactions with the companies.
So I did want to mention that at the time of this recording, when this recording will be released, we already would have released an episode by Nik Modi, who your son was at the CAGNY conference. The CPG guys were so impressed by what he had to say to us, including an article that he presented to us. The topic of that was investor and performance from the eyes of a Gen Z, he saw, which was absolutely fabulous. For those of you that didn't hear or watch that episode, you can find the links on the digital liner notes of this episode. To our audience, a reminder, you can find all of our content simply by going to a web browser and typing cpgguys.com as the URL. If you or anyone you know can contribute to this ongoing discussion of the industry and shaping the future outcomes of what happens here, please do drop us a line and email at contact@cpgguys.com. Again, that's contact@cpgguys.com. I'll ask you to leave us a rating on the Apple Podcast or on the top right corner of our website on cpgguys.com. The rating tells us how we're doing. A review will be very helpful because it'll tell us whether we're having quality discussions on the right topic. To our audience and our followers, especially on LinkedIn, I can't say thank you enough times. Your clicks, likes, DMs, meeting us at conferences, recording podcasts, doing what Nick did with me, impromptu recording a podcast episode with me, and of course, our sponsors through the year. Without you, we don't exist. So thank you. Nick, thank you for having an open and frank conversation with me about the state of the industry. You're always welcome back on the show. I was looking forward to record this one. Thank you so much for joining me.
Thank you for having me.
Thank you, Nick. And with that, we'll wrap this episode. Wait for it. Of the CPG Guys.
content in this podcast episode is provided for general informational purposes only. By listening to our episode, you understand that no information contained in this episode should be construed as advice from CPG Guys LLC or the individual author, hosts, or guests, nor is it intended to be a substitute for research on any subject matter. Reference to any specific product or entity does not constitute an endorsement or recommendation by CPG Guys LLC. The views expressed by guests are their own, and their appearance on the program does not imply an endorsement of them or any entity they represent. The views expressed by CPG Guys LLC do not represent the views of their employers or the entity they represent. CPG Guys LLC expressly disclaims any and all liability or responsibility for any direct, indirect, incidental, special, consequential, or other damages arising out of any individual's use of, reference to, or inability to use this podcast or the information we present in this podcast.